Have you ever wondered how businesses protect themselves from employee dishonesty? Let us break down exactly what a fidelity bond is and how it works. At its core, a fidelity bond is a form of business insurance designed to cover losses caused by fraudulent acts of employees. Unlike general liability insurance, which covers accidents, this bond specifically targets intentional wrongdoing by people working inside your company. These bonds can be customized. Some cover all employees, while others might focus specifically on roles with high access to cash or sensitive data. It is important to distinguish this from standard insurance. Insurance usually handles accidents, while bonds specifically address human dishonesty. Businesses choose different types based on their needs. ERISA bonds are specifically required for those managing retirement plans, like 401(k)s. Often, having a bond is a requirement for winning contracts, as it signals to clients that their property is protected while on your watch. Understanding these tools helps you better manage business risks. Thanks for watching, and remember to consult with a licensed professional for your specific needs.